Welcome back. I'm Erika Jones, Fractional CFO, Certified Tax Advisor, and founder of She Knows Profits. I help entrepreneurs and leadership teams transform financial information into strategic decisions that increase profitability, strengthen cash flow, and create long-term growth. Today, I want to talk about one of the biggest lies business owners believe. It's the idea that if your business is profitable, you should automatically have money in the bank. Unfortunately, that's simply not true. In fact, some of the most profitable companies I've worked with have also been some of the most cash strapped. Let me tell you about one of them. I had a client, I'll call him David. David owned a successful digital marketing agency. His company generated more than $3 million in annual revenue. At year end, his accountant sent over the financial statements. The profit and loss statement looked incredible. Revenue was growing, margins looked healthy, net profit exceeded $600,000. If someone looked only at those reports, they would assume David was celebrating. Instead, he was sitting at his kitchen table late at night trying to figure out how he was going to make payroll. He had employees depending on him. He had vendors waiting to be paid. He had estimated tax payments due. He had business debt coming out automatically. And after all of that, his bank account barely had enough cash to get through the week. His first question was exactly what most entrepreneurs ask me. Erika, where did all my money go? If you've ever looked at your financial statements and wondered why your bank account doesn't match what your accountant says, you're not alone. And today we're going to fix that because profit and cash are not the same thing. They're related, but they're completely different measurements. Profit is an accounting calculation. Cash is reality. Cash pays payroll, cash pays taxes, cash keeps your doors open, cash allows you to sleep at night. Profit cannot do any of those things by itself. The biggest mistakes entrepreneurs make is believing that more revenue automatically solves cash flow problems. It doesn't. Sometimes revenue actually creates them. I call this scaling Death Valley. It's the period between the moment you spend money to grow and the moment that money finally returns to your business. Most CEOs completely underestimate how dangerous this period can be. Imagine you land a brand new client worth $50,000 every month. Sounds exciting, right? But before you ever collect that first payment, you hire employees, you buy software, you increase payroll, you spend money on onboarding, maybe you purchase equipment, maybe you increase advertising. Your expenses begin immediately. Your customer doesn't pay for another 30, 45, or even 60 days. On paper, revenue exploded. In your checking account, cash disappeared. I've watched businesses literally grow themselves into financial distress because they confused revenue growth with cash flow growth. Growth without cash management creates stress, not freedom. I see the exact same thing happen in real estate. An investor may have several profitable properties under construction. Their balance sheet looks phenomenal. Their equity is increasing. On paper, they're becoming wealthier every day, but their cash is trapped. Maybe permits are delayed. Maybe contractors fall behind. Maybe material costs increase. Maybe one property requires an unexpected repair. Now, hundreds of thousands of dollars are tied up in projects that won't produce cash for another 90 days. They're technically wealthy, but practically broke. I've seen investors sitting on over $1 million in equity who couldn't comfortably write a $5,000 check without creating anxiety. Again, profit doesn't automatically create liquidity. This is why I teach every CEO to understand one number, your cash conversion cycle. How long does it take for $1 to leave your business and return with a profit? For some businesses, it's 30 days, others 60, some are 90, some even longer. If your cash leaves today but doesn't come back for 90 days while your bills are due every 30, you've built a permanent cash flow problem, no matter how profitable you become. Now let's talk about the 4 silent leaks I see every week. These are the issues quietly draining cash while your profit and loss statement tells you everything is fine. The first leak is accounts receivable. If your customers owe you $200,000, you're financing their business, not yours. You're essentially giving interest-free loans. Imagine reducing your average collection time from 45 days down to 15. You haven't sold anything new. You didn't raise prices. You simply collected your money faster. That alone can completely change your cash position. Cash collection is a growth strategy. The second leak is debt. This surprises a lot of business owners. Let's say your monthly loan payment is $5,000. Only the interest shows as an expense on your profit and loss statement. The principal reduces cash, but doesn't reduce taxable income, so you may be paying taxes on profit that already left your bank account. Your financial statements say you're profitable. Your checking account tells a completely different story. The third leak is taxes. The IRS doesn't care whether you remember to save the money. If you're profitable, you have a tax obligation. Far too many entrepreneurs treat the tax account like it's another operating account. They borrow from it, they spend from it. Then tax season arrives, and suddenly they're looking for money they already spent months ago. One of the simplest systems I teach clients is to move tax money before you ever see it as spendable cash. Separate it, protect it, forget it exists. Your future self will thank you. The fourth leak is capital expenditures. You buy equipment, technology, vehicles, furniture, maybe machinery. You pay cash today, but accounting spreads that deduction across several years depending on the tax rules and available elections. So your checking account decreases immediately. Your profit and loss statement barely notices. Once again, profit and cash begin telling two completely different stories. This is exactly why I believe one bank account is one of the biggest financial mistakes entrepreneurs make. When everything sits in one account, every dollar looks available, but it isn't. Some of that money belongs to payroll, some belongs to taxes, some belongs to vendors, some should become profit, and some should become your paycheck. That's why I implement the profit first system. Every dollar receives an assignment before it's spent. Income lands in one account. Profit has its own account. Owner's pay has its own account. Taxes have their own account. Operating expenses have their own account. Now, every dollar has a purpose. Instead of asking, can I afford this? You simply look at the appropriate account. If your operating expense account doesn't have enough money, you can't afford it. No emotion, no guessing, just clarity. Once you've built the right financial structure, the next step is visibility. Great CEOs don't just look backward, they look ahead. That's where forecasting becomes one of the most valuable leadership tools you can build. Most businesses operate from what's in the bank today, but today's bank balance doesn't tell you what's happening next month or next quarter. A forecast does. I encourage every CEO to build a rolling 12-month forecast. Start with your fixed expenses. Payroll, rent, insurance, software subscriptions, loan payments, then layer in your variable costs, marketing, inventory, travel, cost of goods sold. Now estimate revenue based on your current pipeline, not wishful thinking. Finally, add debt payments, tax obligations, planned investments, capital expenditures. When you do this consistently, you'll see problems months before they happen. You'll know when cash gets tight. You'll know when it's time to delay a purchase. You'll know when hiring makes sense. You'll know whether expansion should happen now or wait another quarter. Forecasting replaces fear with confidence. One objection I hear all the time is, my CPA says everything looks good. That's great. I love CPAs. They play an incredibly important role, but they're historians. They tell you what already happened. A CFO helps you decide what should happen next. That's the difference. Another objection is, I don't have time. My response is simple. How much time are you already spending worrying about money? How many sleepless nights have you had because you weren't sure if everything would clear? Building financial systems actually gives you time back. And finally, some business owners tell me they'll wait until they reach $10 million. The truth is, complexity grows faster than revenue. If you don't have financial systems at 1 million, 10 million won't solve the problem. It usually magnifies it. Here's what I want you to remember. The businesses that build long-term wealth don't simply generate more revenue. They build better financial systems. They allocate cash intentionally. They forecast before making decisions. They separate profit from operating money. They stop managing by their bank balance and start leading with financial visibility. That's the real identity shift. You stop being an overwhelmed operator and become a wealth-building CEO. Revenue may be vanity, but profit is control, and cash flow is what gives you the freedom to make better decisions. If you're ready to stop guessing and finally understand where your cash is going, I'd love to help. Visit SheKnowsProfits.com and schedule your profit clarity call. We'll identify the cash leaks in your business, build a financial roadmap, and help you create the systems that turn revenue into lasting wealth. Until next time, remember this: profit isn't accidental. Profit is built intentionally. The biggest mistake